We are live. Dave, good to see you and welcome back to the show.
Good. It's good to be back. And how's everybody doing?
Doing good. Yeah, no complaints. Just yeah, plugging away out of my home office where I often am pictured. So I'm hoping I actually have some travel coming up though. I've got Acuma, TMC, and MBA annual. So I'm going to start to get back out there a little bit more. The stuck to my office jokes from Rob. I gotta try to lessen those a little bit. So
Oh, it's an honor to be here. The quality of guests that you guys have been bringing in this show is just epic. So congrats on having one of the top podcasts and shows in the mortgage space.
low bar. It's a low bar.
I,
I'm
I,
not pandering. I'm not pandering.
Dave,
It
Dave,
really
Dave,
is.
aren't you going to congratulate me on having one of the top 20 daily commentaries in residential lending?
Well, top 20. I mean, I think you have number one commentary in residential lending, but the
No, no,
podcast
no.
is pretty epic.
That's all. That's all, Robbie. That's all, Robbie. But thank you. So, are you spending? Well, actually, Rich. Go ahead with the introductions. I want to hear what Dave actually does all day
Yeah, well,
because
that's what I want to get into. I
he's got.
want Dave to tell, but let's go ahead and get into it. And this is the big picture, presented and sponsored by our great friends at Depth, Kiri Milam, Leslie Colley, Lindsay Neal. Such a great trio of just super pros in our industry that just if you need your story told, and I would argue in the mortgage industry, there's a lot that needs some help with this. They are the best at it. So strategic brand management, strategic communication, public relations, do a great job. You can check them out at depthpr.com, find them on LinkedIn, or just get a hold of Rob or I, and we will connect you with the fine folks at Depth. So there we have it. And as always, join my esteemed colleague and co-host, Rob Chrisman. Rob, great to see you. Happy Thursday.
Happy Thursday.
And this week, back by popular demand, it is our good friend, the founder of Mortgage Coach, the chief growth officer of TrustEngine. It is our friend Dave Savage. Dave, great to see you.
Yeah, hey, it's great to be here. I'm looking forward to the conversation with you guys.
Looking forward to getting your thoughts on the AI summit you were just at and just AI in general and the kind of the future state of mortgage lending. But before we get into all that madness, why don't you just tell our listeners and viewers about TrustEngine, the Mortgage Coach backstory for those that may not know.
Yeah, so I'm the founder of Mortgage Coach, and at the time that I founded it, I was a loan officer, and really my goal was just to be like the uncommon loan officer, to be the obvious choice. I wanted to be able to ask a customer questions and then literally, have them go like, "Wow, no loan officer has told me that. Wow, you're showing an uncommon level of transparency. I want to work with you." And today, we help tens of thousands of loan officers, 170 lenders were built into the tech stack. We actually just rolled out an AI feature, and so just really proud of our ability and the lenders that use Mortgage Coach to do more than just deliver price. They're really helping consumers make more informed decisions, make better decisions to build wealth with real estate faster. So loving that, and then also very passionate about First Home IQ and helping get more people in their 20s into homeownership through education and just making them aware that the wealth gap in America is who owns versus who rents. Let's help people know the difference.
I love it.
Oh, is that the company that is TrustEngine, the company that IQ is under?
No, so First Home IQ is a 501c nonprofit, completely separate entity. Kristen Messerly is the executive director. She runs that. We've recently built a board of directors. Mitch Kiter has joined our board, Clayton Collins, a number of other people that you guys have had as guests. So it's, other than I work for TrustEngine and I'm on the board of directors and very involved in it, but it's not a separate nonprofit. It's the mortgage industry's nonprofit.
All right. And Mortgage Coach is separate still.
Well, Mortgage Coach is part of TrustEngine.
Okay.
Private
All
equity
right.
firm bought Mortgage Coach, and I'm still a minor owner of TrustEngine, but we're a PE-backed company, and TrustEngine owns Mortgage Coach.
And how do borrowers, potential clients, hear about Mortgage Coach? Is this
So
standard advertising, word of mouth?
yeah, no, I mean, so first of all, I mean, we have a YouTube channel with over 25,000 subscribers, and I do a podcast multiple times a week where I interview top producing loan officers that are winning right now in this market. I'm looking for people that are winning using our technology built into their tech stack. But the YouTube channel is booming. You know, we're getting more views than ever. And then trustengine.com. And then part of my role as chief growth officer is run the sales organization that is bringing new lenders into TrustEngine. So I'm talking to about 30 to 40 different lenders at any given time to get them to build us into their tech stack.
Nice. Yeah, I bet that obviously keeps you busy. And what if you had to gauge the mood of the folks that you're talking to? And Rich, I'm not trying to commandeer the discussion here, but
All good.
Dave, is it hopeful optimism? Is it realism? Is it, oh my gosh, we thought it was going to be better by now. I mean, what's the mood like out there?
I mean, well, the word I keep saying, and it hasn't really changed since the NBA last year, is cautiously optimistic. Although I really felt coming out of the NBA that, everybody was ready to go on the offense, but the realities of the business have kept people on the defense. So it's still, I do see literally in the past 6 weeks a loosening up, and just from the top producers that I interview, I mean, there's some people really winning big in the marketplace. So now I do see kind of the disparity of winning big and still losing and struggling. And when I say that, I'm talking about the field of play, mortgage professionals in the marketplace. But cautiously optimistic, just dying to go on the offense.
Yeah.
A lot of that out there in the marketplace now, for sure. And I would agree. Some green shoots these last 6, 7, 8 weeks that are legitimate. And, we're not seeing them like a mirage in the desert, I don't think, although it is possible. It has been a 3.5 year bear market. So,
Yeah, well, one of my messages, core messages as an industry, we need to just quit worrying about rates coming down. And I was actually did a roundtable with about a dozen loan officers, not, excuse me, C-suite executives the day after the AS Summit in Dallas. And I think that we have this belief that there's like a static number of loans. And by the way, that is, I think, how we operate. Like, hey, and based on interest rates, that number of loans rises, and if they get high, it goes down. I do think we can create loans if we go on the offense with education. And I do think as an industry, we need to do a better job of not just finding loans, winning loans, we need to like start creating loans through education because there's a whole lot of people that qualify to buy a home even at these high interest rates, but they don't know that they qualify. They don't know what their down payment needs to be. They don't know what um, their credit needs to be. There's so much misconceptions that I think we just need to do a lot better job of creating loans as an industry.
love it. Agree.
Well, certainly the refi percentage has been creeping up. It's up near 50%, uh, which is amazing. So anybody who's out there saying, "Oh, the purchase business is slow, so there's no business," is obviously missing a huge chunk of opportunity.
Big time. And by the way, Jason, thanks for the 100%. I know we got a lot. God, we got over 130 plus people live, so feel free to pop in some questions and comments. Rob, I don't know how much you see this, but I see this a lot where like because we have clients that have both distributed retail and they have consumer direct. And they're consumer direct, with working the same database, with the same rates, with the same products, is doing 3 times the refis as a distributed retail. So I also think that's another example where if loan officers were doing a better job of asking questions. They were doing a better job of contacting the customers that they know they should be contacting with. They could be doing a whole lot more loans. Like we're just waiting for the phone to ring with, "Hey, I need a refi. Hey, I want to buy a home." And we need to do a better job of going on the offense. Like we could be profitable tomorrow if lenders and loan officers were just doing a better job on that. My opinion.
How much do you dive into programs? I keep writing about, you know, non-QM, non-agency in general. Loan officers are out there telling me I haven't done a Fannie or Freddie loan in months, if not 6 months or even a year. It's all private money, it's all non-agency. Do you, through Mortgage Coach and so on, get into individual programs, or is it just more helping them realize the general opportunity that's out there?
Yeah, no, that's well, it's I think there's two things. So one, I'm interviewing people that are winning in this market. And so it's coming up that people that are winning in this market are doing non-QM loans. I mean, they're really good at having the buy before you sell conversation. They're really good at doing that. And so it's coming up a lot in the conversations I'm having, just because to win in this market, you can't be just the vanilla 30-year fixed rate loan officer. You need to be able to have non-QM conversations. You need to be able to help with affordability challenges. So yeah, it comes up a lot. But here's the deal. I don't think most loan officers got the memo. Like, not enough loan officers are leaning into those products, in my opinion.
Yeah, it used to be, for a long time, non-QM had to overcome the stigma of being subprime. And then in recent years, you've got Tom Davis, for example, that's out there talking about, oh, by design, not by decline, which I've also mentioned in my commentary. It's a good little saying, by design, not by decline. And the agencies are actually cooperating to a great degree because of the way they price some of their products, and have these loan level price adjustments and G fees that are in there
Mortgage
that
coach
really.
for me is
Sorry about
What's that?
that.
Oh,
I was
um,
I was actually looking for a video that I did with a loan officer that's killing it, that's doing a lot of non-QM. But anyways, keep going.
yeah, the agencies are almost saying, here's this opportunity, take it away, non-agency. And that's indeed what originators are doing, is saying we don't need Fannie Mae or Freddie Mac necessarily. We've got some good products here and some good pricing, and it's easier on our system to some degree than some of the Fannie Mae and Freddie Mac products. So yeah, it'll be interesting to see if that continues to evolve.
Yeah, no, I think it will. Hey, Rob, I have a question for you. I think it was Bill Dallas last year told me that he thought we'd see some interest-only jumbo product for IMBs this year. Has that happened? I mean, I know big banks, will, have really competitive jumbo interest-only product. Are we seeing that in IMBs? I mean, that hasn't come up in any of my interviews. And do you think we will see that?
Where there's a will, there's a way. I remember, Dave, as I'm sure you do, and probably Rich, you too, before 2008, you used to be able to go to investors and say, hey, Lehman Brothers, hey, Solomon Brothers, hey, Smith Barney, our loan officers really want this product. Will you buy it? Here are the guidelines we're going to follow. Here's the pricing we'd like to do. Here's the yield that we're going to deliver to you. Is this something that interests you? And oftentimes, the investment bank would say, yeah, we want to do that. Of course, that virtually vanished in 2008, 2009, and we put in the ability to repay. And you might remember, for some years there, people thought ARMs were against the law, for lack of a better term, which wasn't the case. Now we are definitely in an adjustable rate mortgage market. The percentage of ARM business that's out there continues to increase. And so at the Western Secondary last week, I guess it was just last week. I was, somebody from JP Morgan Chase, and I mentioned this in my commentary. In the lead paragraph, the fellow from Chase said 70% of our pipeline last month was adjustable rate. 70%, 70% of the Chase pipeline. So, say what you will, the banks are definitely heading that way. The credit unions are heading that way. And, as much as people on this call probably don't want to hear it, the brokers and the independent mortgage banks do not tend to do as well in an ARM market. They get beat up by somebody up the street who's got a better rate, because frankly, the ARM investors out there have always been lagging the general market, and it's hard to find good adjustable rate investors. So a lot of the banks and credit unions really use that to their advantage. Steeper yield curve, paying less on deposits, get this ARM business in the door, put some assets on the books. Uh, so yeah, banks and credit unions, I won't say are quite licking their chops, but they feel pretty good about things. Now, when you look at jumbo ARMs and interest only, I don't know when you said Bill said that last year. Maybe he's got great forethought and can look ahead in the market for a year. I know Bill is a huge proponent of some of the other programs that are out there, some of the non-agency underwriting guidelines and so on. And gee, agencies, why don't you change with our economy? Why don't you change with our borrowers? And the industry isn't seeing that. So we could, but as of yet, Dave, that's a really long-winded answer to I have not seen any kind of big move into interest-only jumbo ARM
Yeah, no,
loans.
I hadn't either. I just feel, and I've heard some rhetoric lately about more 40-year options, just things to address affordability. And obviously, interest only would do that. More 40-year mortgages would do that. I remember, Rich, last time I was on the call, you had some really good ideas that I thought made a lot of common sense around affordability.
Yeah, I think Dave, I mean, you see this just like everybody, and I keep pounding this message home, and I'm preaching to the choir to a great degree. But when you're talking about affordability, woe is me, the mortgage piece, beating up a loan officer over an eighth in rate isn't going to really dramatically improve the affordability of housing in this kind of market where you have homeowners insurance costs that continue to go up, housing, or I should say condo assessment, special assessment fees, uh, damages, and property taxes, and the cost of permitting, or if you want to do a remodel, just the hurdles you have to jump through in order to do that. And it's not cheap. None of it's cheap. And so mortgage is part of the affordability, but it's not anywhere near the entire problem.
Well, by the way, not only is it not part of the problem, I don't have the number right in front of me, but by the way, I would push everybody on the call right now. Go into whatever your AI is. I use Chat GPT a lot. I used Perplexity this weekend, and the prompt was something like, "How many people, based off of today's rates, currently qualify to buy a home?" And I'm just going to say it's like 6 million. And then I said, how many people, if rates come down by a percentage point, will that increase? And it was like 2 million. So it's like education and offensive inspiration education is a bigger opportunity. And it's also something that we control. Like we can control the quality of our education. We can control the quality of how we communicate with our database. And it's actually a bigger opportunity than rates coming down.
And Danny makes a great point in the chat about this exact topic. And so, like for a non-QM strategy, how many restaurant owners within 25 miles of the LO need cash out refis and don't know about bank statement programs?
Boom.
Like applied to the real world, what Dave was saying, like we need to go out and make loans and educate people and inform. A perfect example of that in the chat. So, Danny, thanks for sharing that with us. Nancy in the chat, what we've been talking about now here for a few weeks, Rob, that we're starting to see non-QM priced better than agency on on some of the products on the edges, and I would expect to see that to continue to happen. So
Yes, even private money in some cases makes more sense than, if you need something quick, and somebody's willing to, like, for a bridge loan or something or some kind of remodel, private money has been increasing as well. I don't have the statistics on that, but if you talk to, I mean, Dave, you talk to LOs all day long. I'm sure they've got, sources for funds for private money. Hey, I need this money next week. Can you help? Oh, Fannie
Well,
Mae and Freddie Mac, we're going to take, let's see, we got to get the appraisal and we got to do this, we got to do that. So we're looking 30 days out. Well, they want the money next week and they're okay paying 10%, frankly. So,
yeah, yeah, I actually just shared a link in chat. It's the title was How Keith Collins Built $60 million practice in 3 years. So he relocated his family 3 years ago from Sacramento, California to Nashville, and he was $50 million plus producer in SAC. And for the first couple of years, he was doing the majority of his market in SAC and this, but now he's doing like 80% of his business in Nashville. And it's what I can't remember Danny, I think it was Danny who just said by in a lot of that is non-QM business. I mean, he is again, he's just solving people's problems.
Yep.
He's looking for like what are consumers' problems? He's solving the problems. He's using Mortgage Coach to communicate that to the consumer. But I mean, think about that. 60 million this year. He's only been in that market for 3 years and he's just doing what we're talking about here.
Love it.
Dave,
Smart.
have you, in your travels, Dave, you've seen any kind of uh, common denominator? If you said, uh, let's say a daughter of a friend came to you and said, Dave, what are three attributes that you seem to see in successful LOs that I should, if I don't have, I probably should think of something else to do, or if I have, it'll give me a leg up. So what are three interesting things that you would say?
Well, there's a absolute number one North Star. And people would like think, oh, I'm going to say technology. And it's not technology, it's leadership. I mean, I can talk over and over again the customers I have that have the best adoption of our technology. It's leadership. Like they're thoughtful about how they make their decisions and how they prioritize their decisions. I did a interview with Brian Hale a couple of weeks ago where we kind of created this metric to help lenders prioritize. They're like, what can we do to improve the customer experience? What can we do to improve the workflow for our loan officers? And then what can we do that gives ROI? And so the best lenders and the best loan officers are being pretty thoughtful. No, they're being extremely thoughtful around not having too many things that they're trying to do. They're trying to do the right number of things that they can execute. And then I would say this is part of leadership, but I mean, the one commonality of every top producing loan officer I've ever interviewed is consistency. They've got a sales process, and I said the word process. Uh, I've seen a lot of different processes win, so there's a lot of ways to win in the business. But to do elite volume, they have a process. They consistently execute that process. They get really good at it. And then I do think enablement with technology, change management. It's not about the tech, it's about how good a job they do at adopting tech. And so those are the three. Just but at the end of the day, leadership is I've never seen a company or a loan officer or a team execute well if they didn't have good leadership rhythms.
Love it. This is the big picture presented and sponsored by our friends at Depth. Uh, you are a fintech firm looking to have your story told. Uh, Reach out to the fine folks at depthpr.com or get a hold of Rob or I, and we will connect you with them. Rob, I know how excited you are. It's Jackson Hole week, one of your favorite weeks of the year, and I've spiced up a little this week with the another Fed governor. Trump allegedly forced the one to resign, and now we've got Lisa Cook, who Could you picture how happy Bill Pulte was when he found out that she had two primary GSE residences? I mean, he probably, I would have loved to have been a fly in the wall in his office when he got that news. But allegedly, yeah, Fed Governor Lisa Cook with two GSE primary residences, and the Trump Pulte duo is ramping up the pressure heavily for her to resign. Pulte did it's worth Googling. He was on CNBC with Maria Bartiromo, however the hell you say her name, this morning for about 15
I
minutes.
like the way you said it. That was pretty funny.
Was it even close?
And I'm not going to try to say it right. I couldn't do it either.
But yeah, he was clearly animated in his distaste for Miss Cook's, mortgage fraud in his words, and trying to get her to resign. So I leave that to you, and see what you do with it, Rob.
Is there a question in there, Rich?
No, we can get right to the AI summit takeaways.
You know, I hear a lot of talk out there about fraud. Uh, the experienced LOs are saying it's still prevalent, unfortunately, especially occupancy fraud, depending on the pricing, depending on rent or whatever it might be, whatever the situation is. The I don't know I don't know the exact situation, or I mean, I assume that the Fed governor does. I think it's a coincidence that the Fed governor finds herself in this situation. Obviously, we as an industry can't condone fraud or people doing something wrong. Uh, I've heard plenty of people say, "Well, let's take a look under the cover at Pulte Home, mortgage process, and what might we find there." But in this case, uh, Fed governor is supposed to be held above the law almost, and so heck, if you're or I shouldn't say not held above the law. And if you did something wrong, then you have to suffer the consequences. End of story.
So it looks like, yeah, I can't see any scenario other than, her being replaced probably in short order by another Trump. So then he'll have, I think, three of the seven votes. This is like turning into I'm trying to think of the right comp here, like the Supreme Court situation where, so just we'll watch as all that evolves, and will continue to be interesting, I'm sure. So
Well, the thing about the Federal Reserve, as we've said before, and Dave, you know this, the Federal Reserve doesn't set mortgage rates, right? Doesn't set mortgage rates. The same factors that influence the Federal Reserve influence mortgage rates. And, I've been in this business 40 years. The bond market continually beats the Federal Reserve decade after decade after decade to whatever the Fed is going to do. So right now, I think the odds are 80 or 90% that the Federal Reserve will cut short-term interest rates next month. I think that's already priced into the market. And so the question is, if they do cut rates, obviously that'll help things like small business lending, car loans, and things like that. Will it really help the 30-year mortgage rate? Maybe not. Maybe not. Should help adjustable rate mortgages. So it's always interesting to see. We can't predict the future necessarily, but I think that with or without, Trump allegedly making these moves in terms of replacing Fed governors right and left, federal district presidents, the Federal Reserve, I think, will vote anyway in September to lower short-term rates. So how much turmoil do you want ahead of that? But like I said, if she did something that was
one more
against the
Fed
law,
governor, I would argue. If we just get one more to resign or flip, then we'll have four, and we can move forward. So
but all right, Rich, I'm going to put you on the spot here. When you say move
with
forward to
with
what?
with with
What's your goal?
a coherent, financial, monetary strategy. I just, the inaction, the hemming, the hawing, why can't you lower? They could always raise again if it becomes a disaster. I mean, all the 18 other benefits that lowering of interest rates has on this country and the economy. I mean, it's not just mortgage rates and they don't impact mortgage rates, but my take on this. We don't gotta, beat this horse even deader. But I would like to see a little bit more progressive, fiscal policy here in America. So, and also of note, in the Pulte interview this morning, he more forcefully than ever, he said he wants 0%. He wants a reduction to zero, but at least to 1%. It was the most forceful call for that. So we'll see what happens with all that. So, but,
See, I just don't see 0% overnight rates putting the U.S. economy where we should be.
yeah, we'll see. The economy would have to grow into it. You know what I'm saying? Like if you do that and the economy doesn't grow to the levels that the Trump admin feels like it can, then I think you're going to have problems. But if the economy kind of grows into a lower rate climate, and that could happen. So, but we'll see what happens. So,
What's
well,
the
Dave,
what's the chat saying, by the way? I don't have my reading glasses on.
it's
Anything we should
Rich,
address?
you are spot on. There was a quick stumble out of the gate, but you put it back together at the finish line
thank
strong.
you, thank you. Yeah.
Hey,
So
by the way, I would love for everyone on this call, we got over 100 people. I think it would be great for everyone. I'd love you to put in chat, if you think rates are going to be down, put a minus sign in front of how down, like down a quarter, down a half. If you think they're going to be up, put up. If you think they're just going to be exactly where they're at, put a zero. But so same minus 50
When?
basis points, same zero, zero, zero. Zeros are winning. Um,
what's the time frame on this, Dave? Like
Yeah,
when
Dave.
at the end of the year.
by
What are
the
we
end?
going to close the year at? What are we going to close the year at? So it looks like right now, same as winning, down 50 basis points. We got a 75 basis pointer. We got a 25er, 25er, 25er. All right. So yeah, I agree. I can tell you, I'm not betting. Yeah,
I love to gamble.
quit.
If
I
there is some
quit.
way I can actually gamble on this, somebody please let
Oh,
me.
we got 100. We got 100.
I'm in
Maybe
about
Dave,
the
down
50.
100.
I'm in the I
Dave,
30-year fixed rates in the low sixes, I would say, as we flip the calendar year would be my call based on a lot of different things,
I'll take it. I'll take it. We
which
want
would
it.
be huge. I think we'd see big increases in volume, and it would really just change the narrative and the mindset as we go into
I
26.
would not bet against you, but I'm tired of betting on it.
So, Dave, the AI summit, you were just recently at the recent HW AI summit, and really curious just to get your takeaways from that event. AI, my preamble, like I think lenders it's confusing right now. I think that
Oh,
if you're a decision maker at a mortgage lending organization, you're seeing all around you the impact of AI almost daily, the way it's impacting our lives and the power of that technology. And they're trying to figure out how to embed it into their organizations. There's not many, like there's a couple Candor and a couple others like standalone AI products that are really viable and are solving for use cases in the industry, but not a lot. Like literally a couple. So there's stuff that's emerging. There's great products like Mortgage Coach and other existing platforms in the mortgage industry that are embedding AI tools into their products. So for the mortgage lenders, it's very, very confusing right now. Everybody's telling them they need AI. Um, we had the Stratmore most recent survey. Nearly 50% of IMBs list AI investment as their top tech priority this year. That's mirrors what conversations I'm having. At the same time, when you flip the question around, okay, what are you ready to invest in? I don't know. Like, there's just a lot of different options. And, so with that preamble, I would love to get your take on just AI right now, the summit, what came out of it, and all that good stuff.
well, I mean, first of all, one takeaway validates what you said. I mean, it was standing room only. There was 100 or no, 531 attendees, and 70% of them were executives. They were operators playing the field of mortgage. 30-ish% were vendors, which, first of all, I haven't been to a mortgage event in 5 years where vendors didn't outnumber executives. So to me, attention is there. As I said, I had Jim Deitch and I co-facilitated a roundtable. Clayton Collins came to it, and we had a dozen-ish C-suite executives. And the way I always start an executive roundtable is go around the room, briefly introduce yourself and your model. And if there was one question you want to get answered during this time we're together, multiple people were like, where do we start? You
Right.
know, like we were here, we're hearing all this noise. And so I definitely think, validating where do you start? I put a lot of thought into this just because one, I've got a horse in the race. I'm building a platform. We think AI is really important. We have a philosophy around it. I mean, my first message to the market is you need to measure. Like, like, like it's just still frustrating to me that even most lenders can't measure and quickly go what their credit report, which is doubled in cost, divided by fundings, credit report to funding, by loan officer, by region, like, you've got to be able to measure metrics. And I just use that as one example. Like there's other metrics. And by the way, that's when Brian and Hale and I did our conversation last week. It was all about here's the framework. First of all, what can you measure? And then what is your belief that by implementing this AI feature or this technology project or this process improvement that you're going to be able to measure it and you're going to, it's going to move the needle. It's going to improve your profitability. It's going to improve your conversion. So it starts with that. And then I think the other thing that lenders, I think they over-index on trying to improve the work experience versus the customer experience. By the way, that was another takeaway. The CTO of Rocket was awesome. I mean, first of all, highly recommend folks watch that conversation. Very articulate, very transparent.
What was his or hers name? The CTO racket.
I can't remember
Remember?
it.
I'll look it up. Yeah, that's good.
Google it,
Good intel though.
AI, AI.
Yep.
But he was fantastic. I mean, it was one of the best just executive briefings, conversations. He was very transparent. If you and I have studied the Rocket briefings, I mean, they're getting to the top of the funnel,
Hmm.
they're getting applications, they're funding loans, and they're like a quarter into the Redfin deal. So they're like executing top of the funnel really well. They had validated that they're using AI to do, voice AI transfers and that it's outperforming humans. We also had Total Expert say that from stage, so I mean, it's still early in the voice AI game, but I mean, that's definitely something that I think people should be thinking about. And then, our whole AI strategy is how do we make the customer experience better? Like we give people options and strategies, but like where we started was let's let the customer talk to it and say, hey, what's the lowest cash to close? What does APR mean? What if I'm going to move in 5 years, what's the best option? So I kind of lean towards how can you enhance customer experience with AI? By the way, make sure that you can measure it and make sure that you feel that the way you're implementing it is going to improve profitability and conversion. Because my biggest concern is that people are experimenting with AI and they don't have good measures and they don't know how it's going to improve their profitability. And so they're just going to, waste time and money. And they need to, again, leadership, they need good leadership. Those are my thoughts.
Yeah, it's very interesting. It is a level of confusion for lenders right now, and just trying to make sense of it all. And all their existing technology providers are, letting them know about AI-based updates to their product. They're getting pitched by AI companies with really no
Oh,
track.
everybody. I mean, everybody's got AI. And by the way, whether they have it or not, like I would like to hear more data-driven AI stories. That's one thing I'm going to put on. I recommend you guys do this because I do think, and I'm going to try to do it on our podcast, The Mortgage Coach. But like, I want to hear what you're doing with AI, but I want to hear your data, like data-driven AI stories, not just sexy,
Anecdotal.
fizzly things.
Yeah, yeah. The future loan originator, Dave. You speak with top producers regularly on your YouTube channel. What a great insight into the mind of people that are succeeding, are winning. You've mentioned some of the elements and characteristics that you've seen in that group of people. Um, the role of, the future role of the LO, it is really, I mean, it's LOs are going to be able to do a lot more. Like I've heard some people pontificate about like, could one person do $1 billion with the right support team
I
around?
saw that post. I saw that post. I mean, I don't, first of all, it's not going to be one person, but can a team?
Right.
I mean, heck, Sean Benoshian is a team,
Right.
a team, and he's doing a bill.
Yeah, it's and the more this tech is advancing so quick, and the ability, I think there was another survey that I saw was from McKinsey. I think it was that 70% of like all of the LO like administrative tasks could be currently, even in the current state of AI, automated by artificial intelligence. So if you're an LO out there and you're still doing 30% or more of the administrative tasks that are part of your role, this survey would indicate you're behind the curve. That's, I would argue, probably accurate, right, Dave?
Yeah, yeah. That the CTO of UWM was really advocating, agents and really it was almost like he had equity in ChatGPT because he was like, the $20 version isn't enough. I mean, I think like five different times in his presentation, you need the $200 version of ChatGPT. I am personally researching that. I don't know if I'm just too cheap because I've got the $20 version, but I'm thinking about upgrading to the 200. But it was, and the case was around agents and using the agents to do that. I have interviewed a couple loan officers that are getting there. It's still pretty new, although several people that I trust and respect, are saying that, hey, 2025 will go down as the year where AI agents, the year of the agent. I am personally seeing that more talk than execution right now. But I am seeing smoke. Like I'm seeing smoke. And so I believe that it is going to happen and it's happening really fast. I mean, like the speed in which I mean, I've never seen technology adoption proliferate like this. And it's happening fast. And I do believe it's going to be game changing.
It's unbelievable.
Hey, do you think that normally a seasoned loan officer, it takes a while to become a seasoned loan officer. Start off like maybe as a processor or an underwriter, or then you maybe become a loan officer assistant, or maybe you start being an LOA and then you become kind of a junior loan officer, and there's a progression. Do you think AI takes away the learning ladder for people coming into this industry?
Well, I don't think it takes it away, but I definitely think it accelerates it. I mean, I don't think I know it accelerates the learning curve, and and I've seen that happen. I mean, I have different loan officers they're bringing in new loan officers, and the technology that they have now, the access to AI, the scenario desk that it represents. I definitely think it makes learning to be a loan officer and operating as a productive loan officer much faster and accelerates that, which would have taken a couple years. Because I mean, for most of my time, I've seen people come in, and if they're going to kick ass, like it's obvious in 2 to 3 years. But I think now it's becoming obvious in like 3 to 6 months, and yeah, and that's here to stay. So I think it's a great opportunity to get young, Gen Z and millennials are old now, into the mortgage space. I think we'll see that happen now. We've been talking about it for a decade. I
Great
think
point.
I think we'll see it start like happening.
It's interesting when I hear people talk about AI or companies talk about AI, they oftentimes preface whatever they're about to say with, we really value our people, or we really value the human interaction. But here's where we're going with AI, you know. And so I think it'll be interesting, definitely growing pains in terms of, yeah, the technology can help originators leverage their abilities. The question is, do the originators develop empathy? Do they develop wisdom? Do they develop, psychology? Because all these things and more roll up into being a good LO. And if you're just kind of sitting there monitoring AI, I don't know if you get all of that. But maybe
No,
I'm old fashioned.
no, you're not old-fashioned. I think you're right. I mean, it could definitely hurt critical thinking skills, problem solving. Uh, and by the way, that was a real topic at the roundtable where multiple executives were, I'm a relationship person. I care about my people, like a lot of empathy and care, but we're seeing AI and how it is replacing roles, and what would take X number of people can now take smaller number of people. So there was a lot of discussion of how do we use it to be productive? How do we repurpose people, and just how do we drive more productivity and success so that we don't have to lose people. But we do need to either do more business, and it's probably a little bit of both. Less people to do the production of the business, and we need to do more production. But I mean, what I'm obsessed with is how do we help local loan officers future-proof themselves, at the macro, and I do believe that at least for the next decade or so, the local LO can really thrive. I just think they need to change some of their habits and some of their skills.
Yeah, could not agree more. I think that there's, yeah, huge opportunity for local LOs, but yeah, it does require a resetting and an upskilling of, yeah, how you kind of process data, communicate with people, market yourself. And but two great points to end this, and that I haven't heard talked a lot about. Dave, your excellent point that AI makes it a lot easier for good young people to get in the industry. And I've been saying forever, like it's what I did when I was 19, 20 years old. I was like, I can make money in this industry. Like I know I can. Like, and that I that's there's few other industries where if you're smart and are willing to work hard, you can make good money at a young age and not have to, like, go up the 5%, salary increase every year, pay cycle for, like more traditional employers. So, and then Rob, your point as well about just, what does this do to, the human skills of LO over time, empathy and, problem solving and logic and all that good stuff. Be interesting to see how it all plays out. So, but
Yeah, when you I know we're way over time here, but if I go to get my car fixed, back many, many years ago, there used to be a guy. He
mhm,
could fix your car.
mhm.
Oh, brakes, tires, carburetor, whatever. He could fix it. Now, the guy to fix your car, you have to think about, okay, how am I going to get something that's making a noise? Where do I take it? Are there people out there who have the skill set to fix a car? So I don't know. Old fashioned.
And yeah, Bill, OSU, Texas, can't wait. 10 days, 9 days, 9 days away. So can't wait for that one. And yeah, myself and the CEO of the Texas Mortgage Bankers Association made it a little bit more interesting. So be a fun one to kick off the college football season. But there we have it. And as always, the time flies by.
By the way, is that this weekend? Because you
This
did
week,
a pretty cool post. Uh, who's playing this weekend? I forgot the name of the
it's
team.
in
That's
Dublin.
very
It's
big.
Iowa State and Kansas State are playing in like Dublin, Ireland, I think is the only like real, like notable game this weekend. And then everything gets kicked off college football next weekend, really.
Texas.
Texas, Ohio State, number one versus number two.
That's going to be a
Next
good
week.
game. I
Yeah.
hope it's a good game.
Yeah. Rob with the hook 'em horns there. I saw that, Rob. But it'll be fun. One versus two. No number one, no preseason number one in college football history has ever been an underdog week one. So we'll see what happens with all that. But well, good stuff. Want to thank all of you for spending part of your Thursday with us. We'll be back next Thursday at 3 Eastern on The Big Picture. If you're watching on YouTube or listening on Pod, don't forget we do the show live. Gets a nice little live group chat, always fun and lively. So go to ChrismanCommentary.com if you want to get signed up for the live version of the show. Thank you for all the nice comments in the chat. Thank you to Dave for joining us this week. Always a great and insightful convo. And to my esteemed colleague and co-host, Rob Chrisman, for the, as always, insightful comments. So good stuff.
Take care,
All right.
everybody.
Have a great rest of the week and weekend, everyone. We'll see you next Thursday. Take care.